Hello, ladies and gentlemen. A few students have asked me to do the 2024 question paper. So what I'm going to do is I'm just going to walk through this question paper with you. I'm going to do in this video question 1 and 2, asset disposal, adjustments, and financial statements. So let's have a look at question 1. On the 1st of March 2019, the fan industry started operating, and on the same day they purchased various manufacturing equipment to the value of 500,000 Rand cash. On the 1st of July 2022, more manufacturing equipment was purchased on credit, 200,000. So we started with 500,000. And then there was another purchase of 200,000. On the 2nd of October 2023, the fan industry sold used machinery for 40,000 Rand cash. This manufacturing equipment was purchased on the 1st of March 2019 at a cost of 80,000. So inside this 500,000 purchase of manufacturing equipment is a piece of manufacturing equipment which cost 80,000, and it's being sold on the 2nd of October 2023. Depreciation is calculated on the manufacturing equipment at 15% per annum on the reducing balance method. Diminishing balance method. Don't forget, you also need to know the straight line method. This example is on the reducing balance method. So let's have a look what we need to do. Excuse me. Use the given information taken from the books of the fan industries to prepare the following accounts in the general ledger for the period 1st of March 2023 to the 29th of February 2024. So our financial year runs from the 1st of March until the end of February. See, it's the 29th of February, so that must have been a leap year. The financial year for the fan industries is 29 February. So 1st of March to 29 February. The current year is 2023 and it ends in 24. We need to prepare the manufacturing equipment account, the accumulated depreciation on manufacturing equipment, and an asset disposal account. And it says round off all answers to the nearest Rand. Show all your workings clearly. Balance all accounts. Now what I've done here is I've drew up a little timeline. It just gives me a little bit of clarity on all this written information. So this business commenced on the 1st of March 2019. That was year 1. Year end was in 2020, February. Year 2 ended in 21. Year 3, 22. Year 4, 23. And we're going right until the end of year 5 of this business, 2024. So the first thing I would do in a question like this, I would get the opening balances, open the general ledger accounts. I would get the opening balance of the manufacturing equipment account. Remember, the opening balance, we're doing this for the current year, which is the 1st of March 2023 to the 29th of February 2024. So we need the opening balance for the manufacturing equipment account and the accumulated depreciation on manufacturing equipment on the 1st of March 2023. Now the cost of the manufacturing equipment, or the balance, is quite easy. because we started this business off by spending 500,000 on manufacturing equipment, and then on the 1st of July 2022 there was additional equipment bought for 200,000. So in 22 there was additional, year one there was 500. So 500 plus 200 is equal to 700,000. So in the manufacturing equipment account, on the 1st of the 3rd, 2023, the balance brought down will be 500,000 plus 200,000 is equal to 700,000. That's quite easy. Now let's have a look at the accumulated depreciation manufacturing equipment. We need to calculate the balance brought down at the start of the current financial year. And let's see how they get this 258,998. So you need to do some workings. And if we have a look at the workings for that opening balance, I'm going to show you what they've done here. I don't always do my workings like this, but as you do more questions, you work out your own method. So at the end of the first year, February 2020, there was equipment A and equipment B. Equipment A is 420,000 and equipment B was 80,000. Now remember, they said 500,000 Rand worth of equipment was bought, but they give us information where they say in the 500,000 was equipment B worth 80,000. So obviously there were two pieces of equipment, or maybe more, but they tell us that the one is 80,000 and the rest will be 420,000. So in your workings, that's how they get 420,000 and 80,000. Excuse me. Now they say depreciation is calculated at 15% per annum. So if I go and say, I'm not going to do all these calculations, but 420,000 times by 15% is equal to 63,000. Then if I clear that, the 80,000 times by 15% equals 12,000. So in year one, at 15% per annum, using the reducing balance method, the depreciation for equipment A was 63,000 and equipment B was 12,000. Now if you balance the accumulated depreciation, seen it's year one, that is the only depreciation to date. So for A will be 63,000 and B 12,000. Now at the end of 2021, this is the reducing balance method. So to calculate the depreciation in the second year, at the end of 2021, we must say, let's do A first, 420,000, which is the cost price, minus the accumulated depreciation to date is 357,000 multiplied by 15% is equal to 53,550. Right, 53,550 and plus 63,000, 53,550, or 63,000 plus 53,550 equals 116,550. Now for B, what we need to do, it's the reducing balance method. So we got the cost price, 80,000, minus the accumulated depreciation, 12,000, equals 68,000, times by 15% equals 10,200. And 12,000 plus 10,200 will give you, at the end of 2021, the accumulated depreciation balance for B of 22,200. Now when you do the end of year 3, you take the cost price minus the accumulated depreciation times by 15%, gives you 45,518. 45,518 plus 116,550 is 162,068. And then for B, you say 80,000 minus 22,200 times by 15% is 8670. 22,200 plus 8670 is 30,870. Then you use the same method for the next year, and the next year is 2023, February 2023. But in 2022, in July, a new piece of equipment was purchased for 200,000, and you've had this 200,000 rand worth of equipment. I think it was purchased in July. You need to calculate the depreciation on this new equipment. Let's have a look when this new equipment was purchased. If you can't remember. Yep, on the 1st of July 2022, further manufacturing equipment was purchased on credit. Now it's the 1st of July and our financial year ends in the end of February 2023. So I'm going to count on my fingers quickly because it's the 1st of July. You got July, August, September, October, November, December, January, February. I think I get 8 months. We'll check now. What I'm trying to do is calculate the depreciation for our new purchase. So let's bring up the calculator again. We've got 200,000 multiplied by 15%. That's 30,000. But I think we had this for 8 months. So I say multiplied by 8, divide by 12, and it's equal to 20,000. Now at the start of the new financial year, the current financial year, this year, let me see if I can draw quickly. This year, if you add those three amounts together, you are going to get the opening balance for accumulated depreciation at the start of the financial year. 200,000 plus the 38, 258,998. Now let me show you. If I go back up to this account, look at that. That is the opening balance on the first day of our financial period that we are looking at. So we've calculated the opening balance there, for the cost on the first day of the new financial year. And we've calculated the opening balance for accumulated depreciation in the manufacturing equipment on the first day of the financial year. Look, that was 9 marks. Don't forget to do your workings, because if we have a look here, calculating all these amounts, if you didn't get it right in the account, the person marking your paper will have a look at what you've done in the workings. 9 marks for the opening balance. So I hope you're following. This is the reducing balance method. You can get the straight line method. So if we have a look here, there's the opening balance. Now, as you practice asset disposal more and more, you can develop your own methods. I'm just using one that works for me. So the first thing I did was put in the opening balance for this equipment account and the opening balance for the accumulated depreciation account. Then what I need to do is, and this order doesn't matter exactly, but the first thing what I'm going to do is I'm going to transfer the cost price of the equipment we are selling. Now, they said the cost price of the equipment was 80,000. There it is, 80,000. And we sold it while we're up here for 40,000. So that's information we're going to use. So we need to take out the 80,000 from the cost account, the manufacturing equipment account. So this account here is credited with 80,000, and we are going to take that 80,000 to asset disposal. We're going to debit asset disposal with the cost price of the item that we are selling. Then what we're going to do is, the next step I'm going to do is this depreciation. We're going to depreciate up until the date of sale. The item that we are selling, we need to depreciate up until the date of sale, and the amount is 3654. Now, it's very important, when I was going through this item was sold on the 2nd of October. That means you don't include October. So we've had this item that we are selling from the 1st of March until the 2nd of October. When I initially did this, I calculated 8 months, but it's actually 7 months. And what we need to do, because this is the reducing balance method, we need to take the cost price of 80,000. We need to subtract all the accumulated depreciation of this equipment up until date of sale, and then we need to transfer the accumulated depreciation to the asset disposal. But what we're missing is the depreciation for the current year. So if we go to our workings, and this is the difficult part in this question, we're trying to get this 3654, and we are selling B, right? So let's have a look here. The cost price of B is 80,000. We need to subtract the accumulated depreciation of B, which is 38,240 to date, minus 38,240 will give us an answer. We multiply by 15% multiplied by, because we sold it in October, 7/12. So let's check if I've taken the correct numbers. We are trying to calculate the depreciation up until date of sale on the reducing balance method, which means cost price minus accumulated depreciation multiplied by 15%. So the cost price was 80,000 minus, at the start of the year, the accumulated depreciation for B was 38,240, is 41,760. Okay, that is the book value at the start of the year. We multiply this by 15%, 6264, and we've had it for the current year for 7 months, multiplied by 7, divided by 12, and thank goodness we get what's on the memo, 3654. 3654. There it is. Okay, so that's the depreciation amount up until the date of sale. So let's have a look. We've got here depreciation 3654. Now what we need to do, seeing that we've depreciated this up until date of sale, we need to transfer the accumulated depreciation for asset B, the equipment B, to the asset disposal account, and the amount is 41,894. It must get transferred to asset disposal. Where did we get that 41,894? Let's go check our workings. Now that we just did this 3654, the 38,240 plus the 3654 is equal to 41,894. That is the accumulated depreciation of equipment B up until date of sale. Because what we're trying to get in this asset disposal account is the book value, right, of equipment B, which we now have. So there we transferred the accumulated depreciation of equipment B to asset disposal up until date of sale, 41,894. Now if you said 80,000 minus 41,894, let me do it quickly while we add it. Gonna try and move the calculator while this person sends me a message. So we've got 80, 1, 2, 3, that's the cost price, minus the 41,894, 41,894. Remember, you rounded this all off to the nearest rand, that's why we got round numbers, is equal to 38,106. That is the book value of equipment B. In our books it's worth 38,106. And what did we sell it for? 40,000. So if I said 40,000 minus 38,106, I'm just going to put in here minus 40,000 minus 1,894. Ignore that minus, because this is actually there, a profit, because the book value was 38 and we sold it for 40. So on the debit side, in the asset disposal account, you're going to have a profit of 1894. Then both these accounts, the debit side and the credit side get added up and they total the same. And this amount here, the 1894, it would have gone to a profit or loss on sale of account and was a profit, so it would have been credited 1894. But you're normally not asked to do this account, so that's why this is debited, because it's actually closed off to an income account, profit and loss. So now we've done asset disposal, we got the balance brought down, we've done that depreciation. Now we need to do the depreciation at the end of the financial year for the remaining equipment, the equipment we still have. And that amount is 59886. And how did we get that amount? I will show you. If you add the 32886 plus the 27, remember we've done the 3654, that was the asset we got rid of, and we still have A and C, and if you use the reducing balance method, you will get 32,886 for A and 27,000 for asset C. And there's just a little calculation of the profit we've already calculated. So 32,000, yeah, plus the 27,000. Those two final depreciation amounts are going to make up this amount, yeah, 59,886. Then all you have to do is balance the B accounts. So you will balance your manufacturing account, right, so you will have 620,000 Rand worth of equipment left because you had 700,000 minus the 80,000. Then you're going to balance the accumulated depreciation account, and this one here has already been closed off to the profit or loss. So that was question 1, asset disposal. Okay, I'm going to stop this video. Then I'm going to do question 2 in my next video, but that was the reducing balance method for last year's exam. But you must know the straight line as well, eh? The straight line is just to work out the depreciation on the original cost every single year, not on the reducing balance method. Okay, I hope you enjoy question 1 and you understand it. It's a difficult question. It takes some time, but it is very good practice. Okay, cheers.